Good afternoon and welcome to the Wavy Tunnel Pro. Today we're going to cover the end of trend trades, the PW, which stands for price to wave and fill the gap. We've already discussed the breakout trades, the breakouts 1, 2, 3, and 4. Now we're completing the market cycle for the end of trend, and then the cycles repeat. So then we would go back to the breakout 1, 2, 3, and 4, PW, and fill the gap trade. Let's see how that works. Just read this disclaimer to yourselves, please. So the Wavy Tunnel Pro is still one of the best Fibonacci and Elliott Wave-based trading strategies out there. And we hope you will agree once you start to really master the material and intuitively understand how this works and objectively understand how this works. So today we're going to discuss the two end of trend trades, price to wave and fill the gap. We are also going to circle back to Module 4 of the Elliott Wave series and discuss the trade management technique that was discussed there before we do the 3 profiteers tomorrow. Now, there's a question about the videos for the previous session, so I'm just going to, let's just circle back to the website. And this is the ElliottWaveUltimate.com website where your course material is housed. If you put your mouse on top of Wavy Tunnel Pro Home, the course material is under course, so these are the modules. The live webinar recordings will be under Live Webinars 2019. So if I click on that, initially what pops up is the schedule. This is the live webinar schedule. The first videos will be under the introductory sessions. We have the course overview, the trading platform review, the forum instructions, and then we have the 2 live sessions, the first on Elliott Wave series modules 1 and 2, where we discuss the trend trades, and then the corrective wave section, Elliott Wave series modules 3 and 4. This is the video for that where we discuss the Elliott Wave corrections. The Wavy Tunnel Pro videos are under the Wavy Tunnel Pro section. That's what we're going through now. So yesterday we discussed trend following trades, modules 1 and 2 of the course. And today we're going to discuss the end of trend trades, module 3, and circle back to module 4 of the Elliott Wave series. We also have the forum. And the forum is located in the Elliott Wave desk. So you go to the Elliott Wave desk and you just click on forum and log into forum. And where we're posting analysis under Forex trades, stock trades, commodity and index trades for those that want to post their analyses. But if we scroll down to Elliott Wave trading work, this is where we're posting the Elliott Wave trading work. And we can start posting under the Wavy Tunnel trading work. Okay, so the course postings will be down here. So I urge you to get involved. There's a lot of discussion about wave counts in the forum, which is just great. So this is where we are today. So the first thing that we're going to do when we write a trade plan is composed of spotting the setup, triggering the entry, so writing down where you're going to enter the position, setting the stop loss, and setting your take profit areas. So before you can do your trade plan, you need to do your analysis. And that whether that's your Elliott wave analysis or your wavy tunnel analysis, it's some kind of analysis before writing out your trade plan. And you can write out your trade plan right on the chart. You can put the entry, the stop loss, and the take profits right on the chart so that it's visual for you. This is our 8-wave setup. This is the 8-wave market cycle around which our wavy tunnel trades are based. So our breakout 1 is really once the wave crosses the tunnel and we start a new cycle. So if the wave crosses the tunnel up, then we're starting a new uptrend. The breakout 2 is when we have the retracement. So the wave might come back to the tunnel and hug the tunnel, and then price takes off for the wave 3. That's called our breakout 2 trade. It's for entering for the wave 3. Then we have our breakout 3 trades, which are buying along the wave 3 slope. So you continually buy every time the market retraces, bounces off the wave. That's our breakout 3 trade. Our breakout 4 trade is after we have a nice wave 4 correction, we buy for the wave 5. And then we have our end of trend trades. So our end of trade trades are what we're going to cover today, the price to wave and fill the gap. Okay, and then the cycle might start all over again into the breakout 1, breakout 2, breakout 3, breakout 4. And the only way to know is to go to a bigger time frame to get the context, to see what kind of context there is to allow us to, to predict the breakout 1, like the start of a new trend. So last week we discussed determining the end of the trend, and these points can come in handy for the PW trade. So we discussed channeling to target wave 5, and then we discussed channeling to target the internal, the subwave 5. I'm not going to go through these again. This is just a summary for you. We projected price in the target zone for the 5-wave sequence using Fibonacci, and we projected price in the target zone for the subwave 5 using Fibonacci. So those are 2 ways to channel the wave 5 target. Then we add the awesome oscillator and we look for divergence between waves 3 and 5. And this actually is part of our wavy tunnel setup, the awesome oscillator looking for divergence between waves 3 and 5. We talked about reversal chart patterns, and we mentioned how the classical technical analysis chart patterns that you may be familiar with can be explained through Elliott wave analysis. For example, the rising or the falling wedge is a diagonal triangle in Elliott wave terminology. Double or triple tops and bottoms can be waves 1 and 2, a very deep correction for wave 2. A 1, 2, 3 top or bottom is really, it's a 3-wave move, an ABC or a 1, 2, 3. We discussed the 8, 13, 21, and 34-day Fibonacci EMA filter as a trading system or a trading strategy to see how the market cycles move and how when we have corrections, price tends to come back to the moving averages, and also the moving averages tend to overlap one another as well. So that was an introduction. We don't use the Fibonacci EMA filter for our system. We use the wavy tunnel system, but that was an introduction to understand how the markets unfold and how they unfold in a trend, and they stretch away from the moving averages, and then they correct. We also discussed candlestick reversal patterns, which we're going to further discuss today. So the Awesome Oscillator is a 534.5 MACD. It's a momentum indicator that takes a 5-bar and a 34-bar simple moving average plotted in a histogram of 100 bars and a maximum of 140 bars on the screen. And we put the 5 SMA signal line on the histogram. The reason why we like to have between 100 and 140 bars on the screen is because that tends to capture the 5-wave sequence where we can see the divergence between waves 3 and 5. That's it. There's a lot of testing done on this front. Bill Williams did a lot of testing to show that 100 to 140 bars seem to capture the 5-wave sequence quite nicely with wave 3 and wave 5 divergence. Many of you are familiar with the 12, 26, 9 MACD, so the standard settings. You can use a MACD, a regular MACD, but I would change the settings to the 534.5. That tends to fit the picture better, the Elliott wave cycles better. So let's move on. Here is a picture of the Awesome Oscillator with divergence. And what this does, it identifies the top or the bottom of wave 3 because you're going to have the peak for a wave 3. When Juan labels his waves, let me just check something. Right. When Juan labels his waves, he looks for the peak in the Awesome Oscillator and he labels it a 3. That's how he does it. And then the divergence happens with wave 5. So this is a textbook picture of a 5-wave sequence. It's the daily Euro chart. This is from the course, so it's from 2012. I did show you more recent examples last week when we discussed the Awesome Oscillator last week. But this is a picture-perfect 5-wave sequence with Awesome Oscillator divergence. And this is exactly the point at which, at the wave 5, where we then start analyzing for our PW trade, our price to wave trade. Now, again, you can draw your channel lines and target the wave 5 using channeling techniques and using your Fibonacci measurements to project wave 5. So when we say projecting wave 5, we mean in 2 ways. The first way would be to project this black wave 5 versus the black wave 1, okay? Or the black wave 1 to wave 3. When we say targeting the subwave 5, then we go down to this internal wave 5 sequence and we target wave 5 of 5 versus wave 1 of 5. So that's what we mean. First we target the full 5-wave move, and then if we want to really get into the details, we can target the internal wave 5 move to try to find that wave 5 target. So this is divergence. Identifies the top or bottom of wave 3. What it also does, it determines the minimum requirements for the wave 4. So the minimum requirements for the wave 4 are when the Awesome Oscillator comes back to the 0 line. What that also means is when you see the Awesome Oscillator with very strong red histogram bars, you don't want to be selling down here at the peak because you know that the green histogram bars are going to start soon and we're going to come back to the 0 line for the wave 4, which means that price will either move sideways to fulfill that requirement or price will do a zigzag. In this case, it's done a zigzag to come nicely back to the wave. If we have a complex wave 4, then we will have the Awesome Oscillator going above the 0 line, below the 0 line, before we finally have that diverging move down for the wave 5 and the Awesome. Okay, so We can't predict what kind of a wave 4 correction we're going to have. The awesome also finds the end of the trend with the wave 3-5 divergence. We discussed that. And it also signals a change in the direction of the current momentum. We just discussed that. That means when we go from red histogram bars to green histogram bars. So that's the awesome oscillator. Nice review. Question, can you repeat how the awesome identifies the minimum requirements of the wave 4? Yeah, two things need to happen. You want to see the awesome oscillator coming back to the 0 line so that you see proper divergence. If it doesn't come back, if you just see bar divergence, meaning bar divergence looks like this. Let's say wave 5 is here, it comes down, and we don't quite come back to the 0 line. Let's say we don't quite come back to the 0 line, but we do see divergence, right? We see divergence, but we don't quite come back to the 0 line. That could mean that we don't have enough bars to show the 5-wave sequence. We don't have between 100 and 140 bars. We might want to go down one time frame so that we do see the divergence with the awesome coming back to the 0 line. So we just want to see the awesome coming back to the 0 line, and then we can say that the minimum requirements for the wave 4 have been met. It's not telling us the end of the wave 4, because like I said, we could have a correction, a longer correction. We can have a WXY. We can have, a more complex correction. It doesn't have to be a straight zigzag. It doesn't have to be a straight flat or a triangle. It can be a complex correction. So we don't know how long the wave 4 will last. We just know that the minimum requirements have been met when the awesome comes back to the 0 line. Okay. Now we're at the price to wave. So we've done our homework, we've done our channel analysis, we've done some Fibonacci projections, and we're pretty happy that this wave 5 is complete. And we also see a candlestick reversal pattern here, an engulfing pattern. So that's spotting the setup. As soon as we see that engulfing pattern, and we're happy. We've looked at maybe the smaller time frames. We're happy that the market is gonna start to move up. Maybe it has already started to move up on the smaller time frames in a breakout 1 trade, for example. So what do? We trigger the entry. We trigger the entry on the candlestick pattern, on the reversal candlestick pattern. This is one way of triggering the entry. It's an early entry. It's on the candlestick pattern. This is a daily chart. So you would be buying above the high of this reversal candlestick pattern. So you place a stop buy. Your stop, hold on a second. Your stop loss is below the candle low. So you have a stop buy. This line moved. It has to be a little bit higher. And you have a stop loss below the candle low. Okay? And for the PW trade, we're looking for the price to wave for the price to move into the wave. So your take profit area would be, it could be at the top of the wave, or it could be even higher. because sometimes the PW trade goes into the wave itself before it comes back down and corrects. But as soon as we see, that's why candlesticks are really important to take note of. We see small-bodied candles, and this could mean a pause in the trend, and that price is ready to come back down again. Because our ideal PW setup is for price to go into the wave and maybe above the wave a little bit, and then come back down below the wave before taking off again for our fill the gap trade. That's right, PW, retracement, fill the gap trade. Here's another one. This is, we see divergence, okay, between the wave 3 and the wave 5. We have a nice wave 4, and then we have an extended wave 5. So we're spotting the setup with a shooting star. There must be a long candle. We have a shooting star pattern. So we trigger the sell below the candlestick low here, trigger the entry, and we set a stop above the price high, and we set our target. In this case, we can ride our target down if we want to, longer than just getting out at the wave, because the first cycle tends to go, the first cycle in this case is going into the gap. And then we see this hammer. It's a reversal candlestick pattern, so we might want to just get out of our trade if we're just taking the PW trade. And we want to re-enter again for a fill the gap. So that's the PW trade. And if we scroll back and look at the picture here, this is the PW fill the gap trade. So this would be under trade plans and one of the module 8 or 9 in the website. So this is a picture of what the PW fill the gap trade looks like, where we have the PW, the first leg. In this case, it doesn't go into the wave, below the wave. It stops at the wave, then it retraces, and then it does a fill the gap. Okay, so you can look at this more carefully in your notes. So the entry for the PW trade, triple divergence is better than double divergence. Sometimes we have triple divergence. So sometimes the market will make a new high or a new low, and so be it. We might take the PW trade and we might miss the entry the first time because the market is extending. The wave 5 is extending. We enter on a reversal candlestick pattern, or we wait for the candle to close above or below the 12 EMA, the filter. And think of a rubber band snapping back to the wave for this setup. That's the price is extended and we're snapping back to the wave. And these are the examples that we looked at. Fill the gap. These are the trade setup conditions. Bounce off or through the wave, headed for collision with the tunnel after the wave 2 or B ends, so after we have the correction. Divergence is present in the awesome oscillator after a 5-wave sequence, and either we're beginning a wave C or a wave 3. So the first 3 waves are always the same, ABC, 1, 2, 3. Zigzags work best with the PW fill the gap trade. And we want to look for the current gap between the wave and the tunnel to be a reasonable gap. So let's look at the fill the gap. Okay. This is a reasonable gap. Now, it's going to be different for the different markets that you're trading. If you're trading stocks, You're going to have a different gap than if you're trading currencies. You just want to make sure that the gap is reasonable. Okay, you need to be going for a reasonable gap. And the bigger the gap, the stronger the wave 3 move has been. We want to see a big gap because then we can have a nice PW fill the gap trade. So this is the gap. So let's take the trade. Oops. Okay, I guess we didn't take the, so this is just showing what the gap is, what we're looking for. So now let's look at a trade example. This is natural gas futures, 1 hour. And we have divergence in the awesome. We had the PW down into the wave, and then we move back out of the wave, and the fill the gap trade would be the move from the bottom of the wave to the tunnel. That's what it is. So you can leave a stop sell at the candle low here, at the close of the candle, and you can ride this gap. You can leave an order to buy it back at the first wave or the second wave and then take a look at it. Or you can use the 3 profiteers, trade management, which we're discussing tomorrow. In this case, price extended past the tunnel, and we usually see that. We usually see price extending past the tunnel. Not always, but a lot of the time we do. So that's your fill the gap. And I love this trade. I love the PW fill the gap. The only danger is that you pick a market top too prematurely. So the market isn't ready to reverse. Like if we're in an extended wave 3 and you say, okay, we're definitely going to correct, we're going to do a PW fill the gap. If we're wrong about that, then the market will likely come back to the wave and then head up again. And how do we know that it's not going to be a fill the gap? So we wait. We let the market come down. We see if the market pauses before making a new high. And if it pauses and then turns around again and starts to move down into the gap, then that's our confirmation. But we don't want to sell prematurely. So if the market comes down into the wave and then starts to head up and makes a new high, well, then we start the process all over again, and we know that we have to buy it. We know that we have to buy it once we take out these highs. So we can trigger the entry at the candle close below in the gap, or we can trigger the entry on the candlestick, the reversal candlestick pattern. Okay, once the market retraces up and starts to come down. This is a 3-candle retracement pattern. It's an evening star pattern, and we would sell below the candle low. Set our stop above the candle highs and take our profits somewhere along this candle. Now this is an example that Anthony put together last year, and let's look at the progression of these waves. There's a question. So PW fill the gap can be after waves 1, 3, 5, A, and C, after moves that are considered as impulses. Yes. Now we don't necessarily have to know what they are. They're after an impulse move, after usually a 5-wave sequence. So it can be after a wave 1, it can be after a wave 3, it can be after a wave 5, it can be after a wave A if it's a 5-wave sequence, and it can be after a wave C if it's a 5-wave sequence. Absolutely. The only difference will be is if it's after a wave A for the B, then let me draw this out. let's say this is an A wave, and we do a PW, fill the gap for the B wave. If you've done your wave count on a bigger time frame, then we're going to go down again, okay? If it's an AB, because then we're going to go down for a C. And we're not going to have that breakout 1, 2, 3, 4 moving up all the way. We're going to move. We're going to move down again. Okay, it's not going to be a trend reversal. It's going to be a PW fill the gap correction. Okay. The wave 4 and the wave 2 could be good for the PW fill the gap setup. Absolutely, Fabian, they could be good for the especially of the wave 4. The wave 4 PW fill the gap, that is more likely than the wave 2. And that is one of our favorite trade setups, the breakout 4, where you do have that extended, and we see that in this picture, you have that extended PW fill the gap, and then you have the move down for the wave 5. So let's look at this. Let's look at this picture, and then I'll take more questions. We start in the upper left. This is the Euro 4-hour. So initially, the wave crosses through over the tunnel. We call that the breakout 1. But then the wave comes back into the tunnel, and so price is correcting. That's our wave 2 correction. That's our breakout 2 trade, meaning price has corrected, but we are expecting the wave 3 to begin. So we still want to take a breakout 2 trade, and our breakout 2 trade can be entered really at any one of these points. Okay, this is a very sloppy start of this move. So the breakout 2 trade can be entered on a breakdown at any one of these sort of 1, 2, 3 points. Then the wave separates from the tunnel. And as soon as the wave separates from the tunnel, we're in wave 3 land. We're in breakout 3 land, where the price pops back up to the wave and comes down, pops back up to the wave and comes down. And we use the bungee. We can use the bungee to visualize this. Well, we're going to discuss the bungee at another time, to capture the retracement into the wave and then moving in the direction of trend again. So these are the breakout 3 trades. We have divergence, and this is what I mean by not proper divergence, because we don't go back to the 0 line, but sometimes we forgive this, and if we wanted to go to in this case, we would have to go to like a one smaller time frame, then we would see proper divergence of this 5-wave sequence. Maybe we don't have enough candles on here. I'm not sure. It seems like we do. But we do have divergence. This is called bar divergence. We do have divergence. We just don't go back to the 0 line here. So we don't have a proper wave 4 here. Okay, do you see? We just don't have a proper wave 4. We have this wave 4 on news, like it's a spike. Okay, but it doesn't look like the best wave 4. Maybe we would call this the wave 4, and then wave 5. So then we have our PW fill the gap trade. Okay, and then the market goes again. So it looks to me like this is like really the start of the move, like a wave 1. So I guess Anthony tried to capture the entire 5-wave sequence on this chart, which he did. So this would be a wave 1, a wave 2, a wave 3, a wave 4, and a wave 5. So in this case, for the breakout 2, we did have a PW fill the gap. And then we start again. Breakout 3 trades, and then PW fill the gap. Okay? And this looks a little bit sloppy. You can all see that this looks sloppy. We actually didn't do a fill the gap until we did a PW, and the PW is price to the wave. And we came back below the wave only over here. And then once we started to move higher, we actually fulfilled the fill the gap trade. And then we start again. Breakout 3 trades, breakout 3 trades, PW, and then fill the gap. So PW is the move into the wave, fill the gap to the tunnel, and then look what happens. Now we have the breakout 1 trade in the opposite direction. So once we've completed this 5-wave sequence, we have our breakout 1 trade, and we start the cycle all over again. Okay, Marius is asking, this means that if W, X, Y have divergence between W and Y, PW fill the gap will not be considered as valid after Y. All right, we're going to have to look at an example. It's possible that we'd have to look at an example for a WXY and see. But yeah, it would work. Here, look at this example. This is, I don't know exactly what this wave count is, but what if this piece here is a WXY? What if this whole piece here is a WXY? Right? We still exhibit the same characteristics up here. We have divergence. It's bar divergence, but we have divergence, and we have the PW and the retracement and the fill the gap. And maybe this is a 3-wave move, a 3-wave correction. So I urge you not to be so fixed on the actual wave count itself. Rather, look at the pattern. Because if you start to think to yourself, if it's a WXY, that's corrective, therefore I can't do the PW fill the gap trade, then it's going to stop you from seeing the patterns. Ideally, if you can map out your wave count and just you've labeled your waves 1, 2, 3, and you're waiting for a wave 4, so you know that, you know that you're expecting a PW fill the gap trade. If in your mind it helps you to do it that way, and then by all means do it that way. But I urge you to look at some of your more complex corrections and just see how the wavy tunnel plays itself out with the more complex corrections. Because it could be that you discover some rules for the complex corrections, and you can let us know. Okay? Like maybe some more work needs to be done on these complex corrections, but I will tell you that this cycle works. So breakout 1, 2, 3, 4, PW fill the gap, it just works no matter what we're in. Okay, I don't understand your comment there. Right now, all I see are sticks. That gives me a headache. Okay. So David has a good question. Which trade would you suggest to backtest first for ease of recognition? That's a good question. Well, it depends how methodical you are. I would start with the breakout one and just work your way down through the cycle so that you really, as you're back testing, you're really getting to understand the cycle. Okay? So start with the breakout one trade, just because your back testing is also learning, seeing these breakout ones, twos, threes, fours, PW fill the gap. You want to just back test all of the trades in sequence at the beginning. And then you're going to be able to see, you know what? The breakout three trades really stand out for me, or the breakout four trades really stand out for me. Or the PW fill the gaps are what I love. I'll tell you from experience, like I love the PW fill the gaps, and I love the breakout threes when we're in trend, and I also like the breakout fours. Those are my favorites. Okay, so what I would like you to do for homework is to find this sequence and post it as your trading work under the Wavy Tunnel trading work section of the forum. So find and label these sequences to try to get your handle on what these things look like. But do you see how, okay, this is a very long, you know, this incorporates 5 waves and like the whole bit. There's a lot of data on here, but I hope you can begin to see that the market really is moving in cycles and that the Wavy Tunnel just captures it so beautifully. Yeah. Okay. Now, remember we said that with the PW, you can just trade the PW and take your profit? Well, you can also trade them both together as a combo. So very often the PW trade is a setup for the fill the gap. So you might want to get in on the PW, but you're waiting for the fill the gap to finish. And taking the PW trade means getting into a reversal trade early. It does. And use the fill the gap trade as a continuation of the price to wave trade. So in Elliott wave terminology, the PW fill the gap trade presents as an ABC zigzag correction, or even an ABC flat correction. And if the PW fill the gap trade is the start of a new impulse, it will then lead into the breakout one trade, right? If it's a wave 4, then it will not. We'll do a wave 5 after that. But if it's the end of a 5-wave sequence, then it will start a whole new sequence in the opposite direction, starting with breakout 1. Okay, we're going to switch gears now, and we're going to talk about trade management. Tomorrow, or Thursday rather, we're going to do the 3 profiteers, but this is what trade management is all about. One, and there are 4 different trade management approaches. One is to get in and out all at once. So you take your position and then you get out of your position. And that is the simplest strategy, right? The second is to get in all at once and to take profits at various levels. That's the 3 profiteers, and that's what we're going to cover on Thursday. The third is to get into the position at various levels and get out all at once. And the fourth is to get in and out at various levels. And that's what the Elliott Wave trading map is about. I think I told you, or I might not have, that I studied with Bill Williams. I went down to his home. There were 3 of us in the class. It was a wonderful week learning with him. And this is where I learned how to use the Elliott Wave trading map. He actually used it and he showed it. But it's very, very aggressive. It's a very, very aggressive way of trading. And you'll see why in a moment as I describe it as we go through it. I'm going to show it to you, and some of you will say, too complicated, I'm not interested. And others might be interested because it's a nice way of taking you through the Elliott Wave cycles and increasing your position size when we're in a wave 3 or about to start a wave 3, and going smaller when we're not in the wave 3. So let's go through it and just bear with me. So bridge is a game. Remember, we're going back to the Elliott Wave series now. So this is actually from the Elliott Wave series, but I've just taken pieces from it, from Module 4. Bridge is a game with rules that cannot be broken, for those of you that play bridge. So with the Elliott Wave principle, there are rules which cannot be broken. The 3 rules that we learned: wave 3 cannot be the shortest wave, wave 2 cannot go below the start of wave 1, and wave 4 doesn't go into the price territory of wave 1 unless it's a diagonal wave. Okay? Chess is a game of pattern recognition and setups. So the Elliott Wave principle also has patterns so that you readily see the trade setups. And the wavy tunnel helps you to see those patterns more readily, like the PW fill the gap, which is going into a wave 4, or the wave 3 breakout 3 trades for a very strong trend move. There are patterns, or the head and shoulders, or the diagonals, triangles. These are all patterns that we've talked about. Poker is a game of assessing probabilities. So we too need to learn the guidelines and wave personalities to assess the probable moves. And the Elliott Wave trading map is about assessing the probabilities of success. So you want to increase your position size for a wave 3. That's basically what it does. So this is a way to trade with multiple lots and know when to be fully invested and when not to be. It really is for advanced traders, okay? And this requires tremendous practice, like literally going through a whole 5-wave sequence. And that's what we're doing, the 5-wave sequence today. And on paper, figuring out what position sizes you would start with based on your account size, and going through the whole exercise of setting your stop loss and setting your profit targets, and seeing actually how much money you would make by using this methodology. You have to prove it to yourselves if this is the way you want to go. Even if you don't decide to go this way, it helps you to understand trade management a little bit and understand that trading can be a zero-sum game if the size of your wins are the same as the size of your losses, and you're not doing anything to increase the size of your profitable trades or extending your profitable trades. Then you might be frustrated as a trader because it's easy for it to be a zero-sum game, especially if you have 50% wins and 50% losses. But you can change that. You can still have 50% wins and 50% losses and increase the size of your wins. And that's what this trading map helps with that as well. So we're using our 8-wave cycle. but we're not using the, let's see if everybody can see just 1 second. I just want to see the settings for a second. Okay. We're not going to do the correction, the ABC correction. We're going to discuss the 5-wave trend sequence. Now, the primary wave count is the red circle. This would be the wave 1, 3, or 5 in red. Remember, we have our color coding system, which we did last week in the first or the second webinar. So we have our primary wave, which is circled, and we label that as red. And then we have our intermediate, which would be orange. And then we have, for the colors of the rainbow, red, orange, yellow, green. And then we have our green subwaves, which are just the 1, 2, 3, 4, 5. So if you were to run this trading map for a long-term position setup, then you would be looking at the monthly chart, which is dotted, the weekly chart, which is the blue line and the red line for the correction, and the daily, which would be your trade entry chart. So because the markets are fractal, you can day trade, swing trade, or position trade using this setup. So these are the time frames that you would use if you use the bigger time frames, daily, weekly, and monthly. And you would be taking your trades off of the dotted line. And I say trade time frame 3 months to a year. At the time when I did this webinar, I just looked at, I think I looked at the euro because that's the example that I used. And I saw that it took between 3 months and a year to finish the 5-wave cycle, okay, using the daily chart. On the next page, we have the intermediate wave count, the orange in parentheses, right? So this would be wave 1, 3, or 5. Like you would be moving down the subwaves. So it could take you between 1 month and 5 months to complete a wave 1, a wave 3, or a wave 5. The time frames, weekly, daily, 4 hour. So same thing as before. This would be the weekly. You would see this, let's say, on a weekly chart, and you would take the trade off of the 4-hour chart. And then finally, if we wanted to use the daily, the hourly, and take the trades off of the 15-minute chart, you could finish this 5-wave sequence in, between 1 day and 3 weeks. So you're doing the exact same thing, but you're either taking your trades off of the 15-minute chart for day trades, or the 4-hour chart for swing trades, or the daily chart for position trades. Does everybody understand this? We haven't gone through the trades yet, but all I'm saying is you can take the trades often off of the 15-minute chart if you're following really the sequence as it unfolds during the trading day, or you can go to the bigger time frames and take the trades off of that. Okay, perfect. So you're all following. Great. Well, let's get started then. So the first thing that we're going to do is divide the trading capital into 10 equal units or lots. Because when you're fully at maximum position, you might have 10 lots being used. So you divide your trading capital into 10 units, okay? You choose a time frame, and we just went over that. 15-minute chart, 4-hour chart, daily chart that you're going to be trading off of. Okay. I didn't get rid of the animations here. Okay, let's go back. You follow directions. The first thing that we're going to do is we determine the end of the trend. We start at point 0. Then we take the trade by determining the entry points. We're going to go through all this. We establish our stop losses, and we add on to the existing position at certain points. We take partial profits at target zones, and we close the position upon termination of the trade, point T. So this is the progression. And on our trading map, we're labeling the buys as B1, B2, B3, B4, meaning the B1 would be buying for the wave 1, the B2 would be buying the wave 2 pullback, the B3 for the wave 3, the B4 for the wave 4. So in this example, we're just using buys. The stop is stop, S1, S2, S3, and S4, and then your profit targets. We're not taking any new trades, we're just taking profits at the end of wave 5. So now we start. We're looking at the 15-minute chart. We've gone through our end of trend analysis to find point 0. We have divergence, we've done our channeling, we have our reversal candlestick pattern. And we have 5 waves, a 5-wave move up for the wave 1, and a 3-wave move down for the wave 2. And we decide to buy 3 lots, and that's my way of saying it's lots in currencies, but you could be trading stocks. 3 out of the 10, 3 positions. You got it? You buy 3 out of the 10 at 50 to 61.8% retracement of subwave 1. Now, you can buy on at a Fibonacci retracement level, or you can buy on the reversal candlestick once the price starts to go back up again. We haven't even introduced the wavy tunnel because this came before the wavy tunnel, okay? So if you do have the wavy tunnel on your charts, fine. You would use the wavy tunnel as well in conjunction with this. So your first buy is after the first 5-wave sequence up and the 3-wave sequence down. Your long 3. You set your stop below point 0. Now, Bill Williams is really very, very aggressive watching him trade, and he would actually stop and reverse. If we went below point 0, he recommended selling 5 lots if subwave 2 falls below point 0. And he didn't develop this trading map, by the way. This was developed by some other people, and I can't think of who right now, but he picked up on it and used it. Okay? I think it was I'm not sure, but I'm not sure. I'd have to check into it. But I think it was one of my colleagues who worked in the industry when I did, Bert, but I'm not sure. Anyway, so you have a stop and reverse below point 0. You sell 5 lots if subwave 2 falls back below point 0, because you know if the market is going to go lower, then wave 2 will go below the starting point again, below point 0. So this is a way to be very proactive and aggressive to make back the loss. If you bought 3 lots, you sell 5 and you buy the 2 back so that you don't lose anything on that trade. Okay? You're watching the market and you buy it back so you don't lose anything on that trade. And you want to move your stop to break even on that trade as soon as possible, because you certainly don't want to lose on that trade. Okay? So you just move it to break even as soon as possible. Most of the time you will have that initial move down if we make a new low. But I would definitely, test it out and see how this works for you, because this requires a certain mindset, doesn't it? It definitely requires a certain mindset. You do not have to stop and reverse. You could just get out of your position, and the other way is to look for a new low and start again. Fine. So now the market does its thing. We don't get stopped out. We don't have to stop and reverse. And the market moves up in 5 nice waves. And we have divergence. And we get out of 2 out of the 3 positions. And we keep 1. We have a nice profit. We keep 1. So at the end of circled wave 1, we have a 1 lot open position. We've closed 2 lots. Great. So now the market corrects, and initially we bought at the subwave 1, wave 2, the subwave 2 of wave 1, right? Now we're buying at the circled wave 2. We buy 5 lots at the bottom of wave 2 at 50 to 61.8% retracement of wave 1. So this can be your breakout 2 trade in wavy tunnel terminology, and you're increasing your position. So now we're long 6 lots, and you don't have to buy at 50 to 61.8%. Again, you can watch, you can count the waves down, the 3 waves down, and you can buy on a reversal candlestick pattern, or you can buy on a small 1, 2, 3 reversal, or you can buy on the breakout 2, your choice. Okay. All right. So this is the aggressive stop loss again. Stop and reverse again. You're long 6 lots, you sell 10 lots if wave 2 falls below the start of wave 1. Net short 4 lots, and you do the same thing. You just you move your stop to break even as soon as possible, and you just make back the loss on those last trades. I mean, that's it. That's it. That's the idea behind the stop and reverse if you're going to get stopped out. I mean, hopefully you won't. The other thing that you could do is, well, I'm not going to add my 2 cents. Let's just keep going. Okay. Then the market moves up. Let's say we don't get stopped out. Okay, I see some questions. All right, let's just back up. So the question is, yeah, if S1 is activated and you sell 5 lots, where would you set the new stop loss? Okay, this is some serious trade management. Jody, we have a nice question from Marius regarding position of stop loss on stop and reverse. Yeah, I don't have, like I said, you're going to be watching it very carefully, and you want to move your stop to break even as soon as possible. Okay? But usually, if we make a new low, we are going to have an impulsive, like a spike or an impulsive move down. You could even set your profit target in your trading platform to make back the loss. Like, you don't care how far down it's going to go. The idea is that you're just proactive and you just want to make back the loss. And then you move your stop to break even. Another question. Would you also go long on the break of wave 3 for the move to wave 5? We didn't get there yet. Okay, so we'll discuss that in a minute. All right. But let's say we don't get stopped out, so we're long 6, and now we want to be fully invested for the wave 3. So we do a 1, 2, 3 buy at once the market moves up again and down again and then takes out the top of wave 1, we buy 4 more lots on the break of subwave 1, so we're long 10. Right? Remember, we're long 5 down here. We had 1 before. We've taken some profits, and we buy 4 more right over here because we're still, it's the beginning of the wave 3. That's what it is. So we want to be fully vested on the wave 3. Okay? Question. Yes, this comment. Yes, this trade management is indeed aggressive. And Richie is asking, and would you trail the stop to the bottom of wave 4 on the 15-minute? Yes, exactly. And we're going to show that on the next slide. Whoops. I'm wondering if I had, hang on a second. Right, okay, here we go. Nope, it didn't go, okay. Let's just look at, so the new stop loss, once you buy above the wave 1, your new stop loss is at the start of wave 1, okay? So you've actually bought, you wouldn't be underwater, you'd be underwater if you have to get stopped out on just these 4, but these 6 would be at break even, okay? Then you do move your stop. This is your revised stop loss. Once the market moves up in a wave 3 and comes back down, this is all based on the rules of Elliott. You don't want wave 4 to go below the start of wave 1. You move your stop aggressively up to this level, and that was basically your entry. Okay, so you sell 10 lots if subwave 4 trades below the top of subwave 1. So that's not trailing, that's not the same as trailing the stop to the bottom of wave 4. We haven't gotten to wave 4 yet, but it's keeping your stop so that the rules are not invalidated. So here we are. If we can get to this point, well, we're making money, right? We're making money on this purchase. We made money on this purchase. And we're breaking even on 4. Let's keep going. Okay, I suppose that you could trail your stop at this point if you'd like to. That was one of the questions. Richie said that's how you usually trade. You trail the stop to the bottom of wave 4. You could certainly do that at this point. Once we take out the top of this wave 3 and you have this wave 4, you could move your stop up to the bottom of wave 4. Why not? Absolutely, you could. Once you've taken out this wave 3 top. Okay, so you have it here initially, and then the market comes down to a wave 4 and takes out the wave 3 for the wave 5 up to finish the wave 3, and you can certainly move your stop up to the bottom of wave 4. Yes. Then here, profit taking, keep 3 lots and sell 7 lots. So now you're taking some decent profit, but you're still keeping 3 positions. You want to take decent profit because what if this is a 3-wave move only? What if this is just a correction and you've miscounted it, right? What if this is a WXY or an ABC, right? So you definitely want to take profits on the bulk of it. Now let's see what happens next. I think this is where I sort of stopped. Yeah, let me just see. I think, yeah, I wanted to leave this open for, I just wanted to talk you through this one. And so let's review what happened so far. So here we've bought 3 and we've taken profit on 2, so we have 1. Then we buy 5 at the bottom of this wave 2, and we buy 4 more to be fully invested for the wave 3 move. And we move our stops up accordingly. Now at this point, we've liquidated 7 positions. We have 3 left. So I didn't have us buying more for the wave 4, but we could certainly, if there's a nice breakout 4 trade for the wave 4, and you see a nice defined 3-wave move, and we have a nice breakout 4 trade, you can certainly buy like 2 more lots, and then you would be 5. I wouldn't want to go fully invested, but you could certainly buy 2 more lots, and then once the market starts to move up, you would move your stop to below wave 4, and then you would liquidate your entire position at the end of the move. So you would have either 3 or 5 lots left, and then you would liquidate. So this is very, very, very aggressive, but it can also be, if you're really, really following the waves and counting the waves, and you're really trying to take your positions when it makes the most sense to, and you can make a lot of money doing this. So if you're very interested in this, then I would strongly urge that you work through an exercise and post it in the forum. And I don't know if there are enough people interested in this. Let's see where it goes. I'm not suggesting anything, but let's see where it goes. Maybe we can find a longer term setup for this and follow it along as a group and take the positions on it. Okay? Yeah, it's the first time I said that. But you're going to do the work to see if any of these, possibilities are unfolding, like if you'd like to do something like this. So now comments. It still amazes me how many possibilities you have dealing with this type of trade management. Yeah, exactly. Richie says, I think this is a good way to trade. Maria says, I'm in. Richie says, because you get most of the move with low risk. Yeah, exactly. Think about it. Think about it. You're taking the bulk of the move with on the wave 3, and the wave 3 that's your low risk trade, isn't it? It's a good idea, Jody. Count me in. Yeah. So enough said about this. Let's see what kind of work we can do on this trading map over in the next little while. Always keeping in mind the wavy tunnel setups as we go, right? So let's just talk a little bit about like our daily trading journal, and then we're going to end for today. And tomorrow, we're going to discuss the 3 profiteers, which is a much simpler trade management style, right? No, not tomorrow, Thursday. Thursday. Thanks for correcting me. Yeah. Goals. Learn the steps required to analyze a market using multiple time frame analysis. Learn to use the daily trading journal, a daily checklist, and a daily trade plan for trading success. So the daily trading journal, if we were to do something like this, the daily trading journal would consist of the trade plans for each of these trade setups, wouldn't it? Do your trading work to determine where you are in the wave count. Review your work with new information. And your trading work is your analysis. The trading journal, like if you want to keep something either written or online, that's your checklist and your trade plan. Your checklist enables you to check off your checklist. And we're going to be showing you a wavy tunnel checklist that Neil developed I don't remember what day we're going to be discussing it, but we do have a checklist for our wavy tunnel setups. Then your trade plan is spotting the trade and triggering the trade, writing down your entry and your exit strategy. And we use a trade plan to remove the emotion. Okay, and for this, we just choose a time frame, right? Are we going to take these trades on the short term intraday using the 15-minute and the hourly, or the medium-term swing using the 4-hour and the daily, or the long-term position using the daily and the weekly? So this we've covered now. We've covered the Elliott Wave series. Module 1, Elliott Wave Basics, where we discovered wave rhythms, pattern, or form. We discussed Fibonacci. We discussed the wave personalities, and we discussed the nomenclature for the wave counting. In Module 2, we discussed the impulsive wave structures and the diagonals and measuring objectives for the impulsive waves. And we went through the exercise of finding the end of the trend, which is helping us for the PW trade in the wavy tunnel. In Module 3, we discussed and got everybody confused with the corrective sequences, zigzags, flats, triangles, and double and triple threes combined patterns with that X wave. In Module 4, putting it all together, that's what we did today, looking at the Elliott Wave trading map. So that's it. That completes the Elliott Wave series. And if you want to read this with me, and then I'll take a few questions, you have been given a toolbox within which you have the answers to many questions. You have learned the building blocks and can now fit the pieces of the Elliott Wave puzzle together. Learning to surf the waves is like learning to ride a bike. You probably feel like you just climbed a mountain. So keep practicing and you will hit the target, the bullseye, over and over again. Happy trading. I'm very creative and I loved putting this together. This is really fun. Questions. Does the market bias during the main trading session on the shorter time frame factor in? Yeah. I think the market bias definitely factors in to which way the market is going to go, if we're in a trend or not, right? I think in terms of the Elliott Wave trading map, it might be easier to take a step back and to do it on a longer time frame initially, especially if we're all going to be like doing something like this. And then using the skills to trade during the day. But I think it requires thought and maybe discussion. And until you get really good practice with it, it might be easier to do it on the longer, like a swing trade type of thing, or the longer term. I don't know if I answered your question. Marius doesn't feel like he climbed a mountain. I feel like I'm standing near Mount Everest. Okay. Well, hopefully at the end of this you will. You will have climbed. So Barnabas is a little bit mixed up. Elliott Wave as analysis method and wavy tunnel as trading strategy. Powerful but challenging. Well, yeah. Elliott, we always say that we start with the analysis first. That's our Elliott Wave analysis, or our Fibonacci and harmonics analysis. And then we use the wavy tunnel as our strategy to take the trades. So I'm going to, let me just see, do we have anything else here? Was that the last page? Yeah, that was the last, right. So I'm going to end this I'm going to end this session right now, and I'll just stick around and answer some more questions for you. But don't forget to post in the forum, and let's, have a look at this Elliott Wave trading map for the forum. And the other thing to do is to look for the wavy tunnel trades. Now that you've learned all of the trades, breakout 1, 2, 3, 4, PW, fill the gap. And we're going to build on those over the next couple of weeks. So thanks very much, everybody. Great class.